Hello everyone, I am Sidhant. So this is the second chapter of the accounting and finance for the bankers. This is the question and answer session, the important question which could be framed in the examination. Let's begin. Before starting, I would like to quote one quotation. Is detach yourself with the consequences. Once the detachment happen, fear vanish and love flourish. So let's start the question 1. Again, I will divide the whole session with the two parts, the theoretical, the important theoretical, as well as the numerical. Again, lots of theoretical part are already covered in the lecture session. Kindly watch it. You will get so much of information, and in this session, whatever the exceptional or the important ones, I am mentioning that. The question 1, the present value of the benefits associated with an asset is called. It's a question. The answer is intrinsic value. For any future cash flows, if you find the present value of that any instruments or any cash flows of the futures, and we find the present value is nothing but the intrinsic value. We are finding nothing but the intrinsic value. That's what it means. The question 2, the relation between the bond price or the yield to maturity. These are the direct questions and are very important questions. So the relation between the bond price and the YTM is inversely proportional. As in the last chapter, we already discussed about the current yield. So this yield to maturity is nothing but a kind of yield that you can say. And in order to find yield, I already have told you the formula of the yield is equal to the coupon value per year, earning per year, monthly or quarterly, or the current market price. So here the question is the bond price and the YTM. The bond price is nothing but the current price, and YTM is nothing but a kind of yield, and its full form is also yield to maturity. So this yield and current market price are inversely proportional. So the answer is inversely proportional. Next question, the longer term bonds are more sensitive to the interest rate change than the short term bonds. This is the direct theorem which is mentioned in the JAIIB course book, and since the questions haven't asked yet in these sections, but all the 10 theorems is important. So this is one of the theorems, that longer terms bonds are more sensitive to the interest rate risk than the short term bond. What does it mean? It means that I am taking the example of the book so that you can relate. Let's say the rate of return is 10%, and it is saying sensitive. So if we take the rate of return is 11%, so what will be the change? And it's, let's say it's for 3 years, and for at the rate of 10% we are taking 3 years and 6 years, and at the rate of 11% we are taking the maturity of 3 years and 6 years. So if the rate of return is 10% and the bond's face value is 1,000 of rupees with the coupon 10%. So if for this and this rate of return for the 3 years, if you find, then you will find the amount will be, for 3 years it will be 1,000 of rupees, and for the 6 years it will be for 1,000 of rupees. Why we are getting the same values, the face value? The reason being, I already mentioned in the last lecture series, in the last lessons, that whenever this rate of return is equal to the coupon rate, then the present value or the value of the bond will be equal to the face value of the bond. So that's why this one is equal. But here, if the rate is 11% for the 3 years, if you find with the formula what I have given you in the last chapter, if you can apply, then you will find for the 3 years the amount will come as 975, and for the 6 years it will come as 958. So it according to the questions, it means to say that if it's 10% for the 3 years, and if the rate increased for the same 3 years, if you find the percentage increase, you will find that the percentage increase is about 2.5%. But if the rate is 10% and it's for the longer duration, the bond is at the longer duration and the rate got changed, then for 6 years, if you find the difference, you will find that it will come at around 4.2%. So this is what the question says. The longer terms bonds are more sensitive to the change in the rate, because more sensitive means more price fluctuation as compared to the less maturities bonds. That's what the question meant. Next, say the question, the coupon face value is 1000 rupees and the coupon rate is 10%, and we know that if we find for the, and we also know that these are the rate of returns. These questions are nothing but also the revision of what you have learned in the last chapter, so that you can relate. The rate of return, I already told you, if the coupon rate is equal to the this rate of return are equal, then the amount will be 1000 rupees. And if it's less, if the rate of return is less than coupon amount, then it must be greater than 1000. And if it's more than, if the rate of return is more than the coupon rate, then the rate of return must be less than 1000. So if you find with the 9%, the amount will come as 1039, and for the 11% you will get 963.04. What does it mean? It means that if we lower down the interest, if we lower down the rate of return, then the percentage fluctuation is more in this as compared to the more in this. So if you find the percentage change with the, if the rate of return is reduced, then you will find that the percentage change will be around 3.9%, but here the percentage change will be 3.7%. That what is only they want to inform you, that if the rate of return got reduced, then the percentage change in the percentage yield will be 3.9%, as compared if we increase the rate of return, the percentage change of the value of the bond will be 3.7%. Numericals might not ask from this section, but the theoretical is very important, because direct the conclusions, or the, we can say, as mentioned in the book itself, it's a theorem that can be asked directly. Now we will come to the numerical problem. The first question, the bond face value is rupees 1000. Okay, the bond face value is rupees 1000, coupon rate is 7%, and it is trading for rupees 975 rupees. Find the current yield. As I already told you, current yield is equal to the market price plus in the denominator, and then numerator the coupon rate, the coupon you are getting. Here the coupon you are getting yearly at the rate of 7%, so the 70 will be in numerator, and the market price is 975. So 70 by 975, you have to use the calculator. 70 divided by 975, so you will get 7.17%, because it's a in percentage term. Always the yields can only be found in the percentage terms. So this could be the answer. Next question, the question 2. I'm trying to cover as much as possible. The different kind of questions can be framed. I am taking all the options. I am taking all different types of the questions, so that it could be easy to understand you, and you can practice as much question as we could, as practice is the key to get through a very good marks in the certification examination. So the next question, the bond with the par value of rupees 1000 and bears a coupon rate of 12% payable semi-annually. Here you have to concern that it's a semi-annually and has a maturity of 3 years. The required rate of return on the bond is 10%. What is the value of the bond? As I already mentioned, that value of the bond I told you the formula. Value of the bond is nothing but the present value. So as in the last chapter we have discussed that yearly you are getting the coupon rate, some amount, and the last you are getting coupon rate plus the maturity amount or the face value that you have invested. So for this you have to apply the annuity formula. What is the annuity formula of the present value? The amount you are getting, 1 plus r power n minus 1 and r 1 plus r to power n plus the present value of what you are getting at the last year. This is nothing and it will be founded the final the compounded value. So the amount you are getting divided by 1 plus r 100 and the total years is the n, the maturity year is the n. So just by placing it, C is nothing but the coupon amount you are getting. What is the coupon amount here? 1000, 12%. So 120 will be the coupon amount. And 1 plus R is nothing but the rate of return is 10%, 10 by 100, and maturity is 3 years. Minus 1. No, there is one thing I missed out, that it's semi-annually. So when it is a semi-annually, the time will become twice and the rate will become half. So we have to take the rate as 5% and the time as 6 here. So 5 by 100, 1 plus 5 by 100 power 6 plus the amount you are getting. The amount you are getting as here in this case you are getting 1000. The face value you are getting at last, 1 plus 5 by 100 for the power 6. So if you solve this, you will get the amount 1050.48 value. So you will choose, you will invest in this bond or not. Yes, you will invest because you are the present value of all the future cash flows you are getting more than 1000 of rupees. So it is investable, and directly from the question you can easily say that since the rate of return is less than the coupon rate, that's why the bond is profitable one. It's as simple as that. Next question 3. The bond amount is 1000, coupon rate is 11%, the rate of return is 13%. The present value of the bond is for maturity 3, 4 or 5 years. The bond amount is given 1000, this is the face value, coupon rate is given, and rate of return is given 13%. Since the coupon rate, for every question if you see, you will just have to process in the mind that since the coupon rate is 11% and the rate of return is 13%, it means coupon rate is less than the rate of return, hence the bonds will be less than this 1000 of rupees. So what you will do for 3 years maturity, what in these questions what you have to do, you have to find for the different maturity period 3, 4, 5. You will find separately for the 3-year maturity, 4-year maturity and 5-year maturity, and you will compare that what changes happen when the maturity period increases. How this happen? How this can help you? This can help you in analyzing the things that if you are investing in bond and it's for longer period, then if it's the case, then you will have to spend your deposit or the money for the shorter period of bond so that you can make profit as much as possible. So if you find for 3 years by applying the same formula as we did in this question, yes, this formula, if you apply this formula for 3 years, you will get the value as 952.71. This is the present value. This is not the actual value. Actual value, what you are getting, the coupon rate of 110 for 3 years into 3 plus the amount 1330, the actual amount you are getting as in hand. But if you intrinsically calculate the values by considering the inflation or the increase in the price of the product, then everything will be concerned, then the real amount you are getting is 952.71. so and why this is less than 1000? Because the coupon rate is less than the rate of return, that's why here it is less. And if you similarly, if you find for the 4-year maturity period, you will find that the amount will got reduced by this much. So, and for similarly for 5 years, 929.87. so you see a decreasing trend. What does it mean? What is the help of this concept? Let's say in future you have the bond of rupees 1000 and having the coupon rate of 11% and the rate of return is 13%, and they are offering you to invest in these bonds. Then you will, as a very financial sound customer, you will deposit only to those bonds which are as less as possible in the year terms. So you will invest in this because you are getting more. I am telling this in this way because you will understand by thinking of the real example, because as it's easy to visualize in that way. So the next question, yes, if since here we are seeing that the amount are discounted, I told you in the last lecture as well what is discounted. 1000 here 952, the present value less than this amount, so it's a discounted. What if for 3 years and the coupon rate is 11%, but the rate of return becomes 9%, which is less than this? It means that the present value you will get more than that, this 1000, let's say some value more than 1000. I'm just taking example, I have not calculated this value. So let's say you are getting 1030 rupees, and for 4 year you will get 1028 rupees. For 5 year you are getting 1025 rupees. So here also you are seeing the decreasing trend. So what the term we have used, if the amount exceeded the present value of the all the cash flows is greater than 1000, the term we have used is premium. Here the amount got discounted, here the amount got premium. This is the terms which is important. So here also the decreasing trend is seen. So you can directly questions can be asked that if the maturity period is this and if the maturity period is this, how value of the bond will increase or decrease, or they can ask like this. So you just have the conclusions in mind. Next question is duration. In the last lecture I didn't touch because I was thinking that it's not that much important, but yes, that's not very much important, but it's unpredictable JAIIB exam, though the questions some of the questions are repetitive, but they can ask to this also, so you should at least know this. So what is duration? First we will understand what is duration. What does it mean? Duration is nothing that if you bought some bond, let's say 1000 rupees bond, and it has some coupon rate, it has some rate of return. But this duration gives you that after how much time, will tell you after how much time you are allowed to sell, so that the risk of interest rate can be nullified. In simple words, you can say that after how much time you can sell this so that you can be in profit. There will be no risk if you sell after that time. That duration will gives you. Duration can be found with the help of the example. This example where you have to find the present value and you have to multiply with the time, and in the denominator you have to find the present value of all the years separately. So in this I will state you with an example. Let's say 5-year bond is there, time maturity time is 5 year, face value is 1000 rupees, coupon rate is 4% and market rate is 4.5%. okay, so since it's for 5 years, so you have to make the table in it 4, 5, and every time you are getting 40 rupees since the coupon rate is second year you will get 40, third year you will get 40, fourth year you will get 40, in the fifth year you will get 1040 because you are getting the matured amount plus the coupon. All the examples in the first year, second year, third year till maturity, we are calculating the coupon amount, some coupon amount, and in the maturity coupon amount plus the face value. What we are doing, we are applying annuity for all these terms and we are separately finding the present value of the face value. But there is another way of doing this, like finding the present value of this annuity separately, for this amount separately, by this amount separately, with just that compound present value of the compound interest formula. Let's say here the present value is 120, we can also find the present value 1 plus, let the interest rate of return is 4.5. any terms. I'm just teaching you how this works. So it's for 1 year, so we will write 1, and again for this 120, 1 plus 4.5, 10, and it's for 2 years, so it's 2, and for the last one 1120 because 120 this amount and this face value 1120, 1 plus 4.5, 10 to the power 5. So here all through this we can also find the present value, but this is quite messy, but at the last through the formula it's very simple to find, but the whole concept is out and out. So if you find the present value of 40 for 1 year, you will get 38.28, and it's 40, let's say here the 40, and it's for 2 years. If you apply this formula, we are placing 40 here, 1 plus 4.5 by 10, and if you do it for 2 years, then you will get 36.63. Similarly 35.04, 33.54, and 1040, it's 834.55. this is the present value completely. And since in the numerator we have to find present value into time, so we have to multiply this with this. So present value into time, you will get 38.28, 73.26, 103.16, 134.17, and 4172.75. this much into this much. Okay, then you have to find the sum of it, which is nothing but a 452.3.61, and here the sum is 978.05. Since here we are finding the present value of all this individually, the present value of all this, and if we apply that annuity formula what we have studied, this formula, you will get the same amount as you are getting here. It's one way of doing it, it's another way of doing it. That one is easy, that's why we are applying that. But in duration you have to find this separately because you have to multiply the time, so we are finding like this. That's I wanted to convey to you. So according to, by applying this formula, you will get this sum. If you divide it by 978.05, you will get 4.63 years. The duration always in years. What does this 4.63 means? It means that after this, if you have subscribed bond, then after keeping the bond with you for 4.63 years, and if you sell after this 4.63 years, you are out of any risk associated with the interest rate. So you have to keep this bond till 4.63 years. After that you can sell anywhere. Since selling is allowed to the bond, as I already mentioned, as it's tradable in the stock exchange, so the stockers or brokers are those who invest in the bonds. They will calculate this value and they will send the bond once after this year, so that there would not be any interest rate risk. Concept is bond price volatility. It's a very important one, the bond price volatility. Here the one formula to calculate, here I will discuss. In the numerator there is a percentage change in the price of the bond, and in the denominator it's a percentage change in the yield to maturity. I will explain this with an example. So the next question is bond price volatility. The bond price volatility can be found by this formula, the percentage change in the price of the bond plus divided by the percentage change in the yield to maturity. What does it mean? We will discuss it. This is the question. The face value is given ₹1000, coupon rate is 10%, period is 10 years. Okay, and the market rate changes from 10% to 11%. So what is the price volatility? Because in market the percentage changes every now and then, so it will ask the bond price volatility is how much. We can calculate this bond price volatility through the formula. Since the percentage change in the price bond, we have to find at the rate 10% what is the value of the bond. As we know that since it's a 10%, the coupon is also 10%, so the market price will be equal. And at the rate of 11%, since it's 11% greater than the coupon rate, and we know that if the rate of return is greater than the coupon rate, then the value of the bond will be less than 1000. We don't know how much it is, so we have to calculate. We have to apply that formula, what we have learned in this. See this formula, and after applying this formula we will find the value as 940.90. so these two values we are getting. So we have to find the percentage change in the price of the bond. So we have to find the percentage change is equal to 559.10 divided by 1000, the total value, into 100, divided by the percentage change in the yield to maturity. The yield, how much the yield to maturity changes. Since the final value is 11 and the previous value is 10, so 11 minus 10 by the base value 10 into 100. So how much we are getting? 10%. So we will write 10% here, and if we convert this into value, it's a 5.910 in percentage form, and it's a 10%. So this percentage got cancelled. So since we are getting 5.91, what does it mean? It simply means that if the 10% increase in the rate of return, or you can say yield to maturity, would cause a change of 5.91% change in the price of the bond. But how the price is changing? It's a negative direction. So we can also put a negative sign here because the price is changing in the negative direction. So with the 10% increment in the percentage of the rate of return or the YTM, there is a 5.91% change in the price of the bond in the negative direction because it's decreasing. So that's it. Revision is very important. I would like to solve as much questions as you could. The good number amount of questions, you will get a very good confidence and you can solve anything. Chapter and revision is the key. Keep doing, keep going, and keep practicing, and you can do it. Thank you.